Benjamin Graham is known as the father of value investing and was the mentor of Warren Buffett, the most successful investor of all time. This book, though written in 1949, really is still relevant. Although investing is much easier these days with the simple use of the internet and even apps to buy stocks, it goes through the issues everyone still faces. Choosing the winners isn't easy. Even more difficult, preventing your emotions from ruining the investing decisions you make. In Wall Street, despite all the research, knowledge, and passion for investing, it is all too common to lose money. But why? The majority of people are just not interested in digging into the nuts and bolts of investing and enduring the pursuit to consume financial information. People are driven by what is popular, the get-rich-quick investing that we know all too well. The intelligent investor must overcome this and make sound business decisions instead of emotional decisions. You do not need extremely good luck or a genius-level IQ to be a successful investor. Rather, all you need is a sound intellectual framework and an understanding of the idea of value-based investing. Once you understand the idea of value investing, it will change your way of looking at the world. Our goal of investment should not be to beat the market, but to reach a solid goal, no matter how long it takes. It is essential to purchase stocks at a price that can secure enough safety margins. And it is through diversified and long-term investments that we are able to accomplish the second essential goal of managing risk. Within the investor class exists a dichotomy: the defensive investor and the enterprising investor. The main difference being the investor's willingness to make an effort and put more time into investing aggressively. The defensive investor makes stable, conservative choices, pursuing a portfolio that requires minimal research and effort, and is thus willing to accept an average return. The enterprising investor has sufficient knowledge, experience, and time to constantly monitor his investments and expand his portfolio in pursuit of a higher than average rate of return. Regardless of which class the investor belongs to, the main premise of the book revolves around value investing, buying securities when they're undervalued based on their fundamentals. Incidentally, the majority of the book foretells the unfortunate and dark reality for most investors: losing your money. As mentioned previously, it is extremely difficult to beat the market. In order to be the intelligent investor, it will always be better to sit on an index fund rather than do insufficient research. Day trading and other methods of speculative short-term investing may be successful and make a lot of money in the beginning, but the overwhelming odds are that you will lose a tremendous amount of money sooner or later. The intelligent investor buys based on price and value. The speculator buys the stock based on overconfidence and the ridiculous belief that he can foresee where the stock price will go. One notable example: buying companies that do not pay dividends. A dividend is a sum of money paid regularly by a company, thus providing you a share in the company. If a firm doesn't pay dividends, you are solely relying on the growth of the company to achieve profit. This is an example of a speculation. Always base decisions on the current conditions and prospects, rather than attempting to predict what will happen in the future. Ignore the hot tips and trends. Pay no attention to the gimmicks, such as formula investing and market timing. It's okay to be boring. Focus on a more conservative and intelligent approach. Understanding the business and the soundness of long-term investment is all you need. Invest in something safe and steady. Something that you can rely on to be a solid investment over the years, especially in undervalued economies and solid bonds. This will help you avoid horrific losses that may be impossible to recover from. In other words, don't try to beat the market, just try to keep up with it. Mr. Market is very fickle and emotional. He falsely steers people toward whatever looks hot at the current moment and away from investments that appear to be old and done. However, eventually the true value of an investment will be realized when the market calms. So, to sum up, how do you become the intelligent investor? Have a margin of safety by buying investments at as far below actual worth as possible. Diversify. The more diversified the portfolio, the less likely that all will fail. Focus on value investing. Buy investments which are being sold below their actual value. As they say, buy low and sell high. And finally, always do your homework. Take the statistical approach instead of the predictive approach because you simply cannot predict the future. This book is more about the person making the investments than the investments themselves. If you want to know what risk is, well, simply look in the mirror. Exercise patience and self-control and be willing to do the necessary investigation, and you'll be just fine. Thanks so much for watching, guys, and I'll see you in the next one. Make it a prosperous day.